Are you investing and sensing something strange in the markets? The US Treasury bond market, normally quiet, predictable, and stable, is flashing red alerts. But the stock market? Still smiling. So the big question is, what do the bond markets know that the rest of us are missing? Warren Buffett is sitting on a massive cash pile. Gundlach is warning investors to take cover. Stick with me for the next few minutes. We're diving into what's happening behind the scenes and what you can do to protect your portfolio. Let's set the stage. On April 7th, Larry Fink, CEO of BlackRock, the largest asset manager in the world, spoke to the Economic Club of New York. Calmly, he said, "Most CEOs I talk to believe we're already in a recession." He also pointed out that US consumers are starting to feel nervous and are slowing their spending. Now, usually, when a major figure like Fink issues a warning like that, investors run toward safety, especially US Treasuries. But this time, the opposite happened. That same day, 10-year Treasury yields dropped sharply from 4.0% to 3.87%, but within hours reversed course and surged back to 4.18%. According to market expert Jim Bianco, this kind of intraday swing has only happened twice since 1998, during the 2008 financial crisis triggered by Société Générale's trading scandal and the day after Trump's surprise 2016 victory. That level of volatility in the bond market, it's not normal. In fact, it's a screaming signal that something is seriously broken underneath the surface. So what's driving it? Investors in bonds are typically calm, long-term thinkers. They're the ones looking 6 to 12 months ahead. And now even they are panicking. They're selling treasuries, the traditional safe haven, and shifting into gold. Why? Because when inflation creeps back, Washington feels chaotic, and policy decisions seem uncoordinated, people start looking for real safety. The narrative on Wall Street is changing, quietly but fast. More and more analysts are expecting economic weakness, possibly a recession, as consumer spending slows, credit tightens, and debt becomes more expensive. And let's not forget the role of interest rates. When bond yields spike like this, mortgage rates go up, credit card debt gets more expensive, student loans hit harder. All of that eats into consumer spending, which slows the economy down. This is what economists call a feedback loop, and we might already be in it. So what are the heavyweights doing? Let's talk about Jeffrey Gundlach, CEO of DoubleLine Capital, also known as the Bond King. He recently went on CNBC and gave some serious advice. Hold 25–30% in cash. That's a defensive position, ready to buy when markets fall. Avoid leveraged bets, no matter how tempting the returns may seem. Stick with short-duration, high-quality bonds. Consider gold, and even Bitcoin, not as speculation but as insurance. Stay defensive until markets find solid ground. Gundlach suggests waiting until the S&P 500 hits 4,500 before going risk-on again. He also sees a 60% chance of a US recession, meaning the market might still drop before any real recovery begins. And then there's Warren Buffett. Berkshire Hathaway is currently sitting on $345 billion in cash and short-term treasuries. That's more than half the company's assets. Buffett isn't running scared. He's waiting. Because when panic hits the market, that's when value investors like him step in to grab opportunities. His cash pile isn't idle money. It's a signal, a warning, and eventually it'll become fuel for massive investments. But only when prices get cheap enough. The US Treasury bond market may not be flashy, but it's speaking loud and clear. And right now, it's telling us that the economic outlook is fragile, and investors are moving into defense mode. So ask yourself, are you prepared for more volatility? Are you building cash reserves? Are you hedging your portfolio against inflation and recession risk? Drop a comment and let me know how you are positioning yourself. And if this kind of analysis helps you stay ahead, follow me for more insights like this. In times like these, understanding the market is not just about making gains. It's about protecting what you've already built.